Markets are down big this morning off the tail end of GDP being reported and a certain inflation number coming in. It was not pretty, guys. And also Meta reported yesterday, as you saw in our previous video, they beat on earnings, they beat on revenue. The stock at one point last night was down 20%. It's now down around 13%. The NASDAQ is down 1.8% right now. The S&P is down 1.4%. We're going to go over that right now because for the first time, markets are only pricing in one rate cut for 2024. Just 4 months ago, it was 6 or 7 rate cuts. There is some conflicting data, but before we get into that, guys, if you like market reactions, if you like stock reactions, if you like earnings reactions, if you like any sort of reaction to the news, subscribe to our channel. And the reason being, we are the fastest to get information out on the internet. We have a team of editors here. We do the video. This video will be live within the next 30 or 45 minutes from recording. That is what's so awesome. We're here to give you more information, so subscribe to the channel. Guys, GDP came in at 1.6% versus estimations of 2.4%. Okay, now some would say, if I'd seen that, I'd been like, oh, okay, GDP was lower. That's more incentive for cutting rates. Why do we cut rates? I've said in many, many videos in the past on our main channel and even here. We cut rates to spur economic growth. So back in December, when everybody's saying, hey, we're going to have 6 or 7 rate cuts in 2024, my comment was, so to have rate cuts, it means the economy is not doing well. We have to remember that. It doesn't mean the economy is going great. It means it's not going well. And now we have GDP coming in at 1.6%. And remember, folks, that's real GDP. That's after inflation. So nominal GDP, which is actually the full overall growth, is much higher, 4 or 5%. But to come in lower than expected, to me says, okay, things are cooling, more likely for a rate hike, but also more likely for a recession, right? But here's the number that came in kind of scary. The personal consumption expenditure index came in at 3.7% versus 3.4% expected, which also was almost double the 2% from last quarter. This is a kind of a view of inflation much higher. This is what scares people a little bit. For the first time in 2024, we're only expecting and factoring in one rate cut, and I think that's for November. Guys, just think about where we were 4 months ago. So why does that matter to this channel? Guys, I always preach. It doesn't matter. We don't know what's going to happen. The other day, Tesla reported they missed on earnings, they missed on revenue. The stock skyrocketed 12%. Yesterday, Meta crushed on earnings, crushed on revenue. The stock was down 20% at one point. Now it's down 12 or 13%. Guys, we have no idea what's going to happen. What matters is one thing and one thing only. What matters is buying good companies at good prices. Let me show you guys the history of the U.S. economy. This is all the things that have happened since actually not even all the things that have happened. This is a small snippet of the bad things that have happened in the U.S. economy going back to the Korean War. Look at all these things: JFK, Cuban Missile Crisis, Vietnam War, stagflation, Black Monday, 18% mortgage rates, Soviet Union collapses, saving and loan crisis, Y2K, Iraq War, dot-com bubble, and it goes on and on and on. That's pretty incredible, right? Let me show you something else. This is average household income going back to 1975. $106,000 per year here, and down here about $12,000 or $13,000. Everybody has gotten wealthier. And this is nominal growth. So again, this doesn't factor in inflation. But if you look at real growth, it's growing. Guys, bad things are going to happen. There's going to be a lot of things that are going to happen out there. The point is, do you believe in the things that worry me the most about the economy are our debt levels and the amount of taxes that we're charging. That really does worry me because I look at it saying, we were the country of opportunity. We were the country that promoted entrepreneurship. And right now it's still promoting it. But the more and more we tax people who generate jobs, the harder it's going to be. We look at the debt levels. Every time you take on debt, you're taking away from the future. You're sacrificing future growth. And we still sit there and borrow more and more money. At some point, as rates stay up, you're going to sit there and have a higher cost on that debt level. Now, for those of you who believe that rates were abnormally high right now, let me show you this. These are 10-year Treasury rates going back to 1960. Guys, in 1960, the 10-year Treasury was around, I call it 3.75%. Skyrocketed and started to come down. Going back to 1870, the average 10-year treasury was 4.4%. Where are we right now? Where are we right now? About 4.7% according to this graph. But we've been as low as 4.2 in the last year. Guys, we're about where we should be historically. Now, I don't mean that to say kiss low rates goodbye forever. I don't know what's going to happen. But I don't want you feeling like, I feel like a lot of people think that current interest rates are like right here from the early 1980s. In 2003, I started to buy real estate. 2004. I remember an agent telling me, well, Paul, does this work though if rates go back to the historical average of 10%? And back then I didn't realize that wasn't the historical average. But what was this person doing? This person was projecting their experience. Their career started here. That real estate guy's experience started here. So to him, everything was lower and lower and lower rates. But really, he was experiencing the worst in our history of interest rates. But guys, to me, high interest rates are a good thing. It weeds out crap. It weeds out garbage. It weeds out all the investors. When rates are this low, guys, anybody can make money. So you have all these average people going out and bidding up prices of assets. You have stupid assets like crypto that people say have intrinsic value. They have no value. You have these things happening. Higher rates eventually will drive out garbage. I don't know where rates are going. I will never try to project it. But if somebody told me today that in the next 10 years, rates were average what they are today, I'd be like, okay, sounds about right. If somebody told me, Paul, in the next 10 years, rates are going to go back to where they were 2 or 3% for home mortgages, I'd be like, really? Wow, that would surprise me more. And that's what's more important here. I want you to learn to be a good fundamental investor, to make good decisions on investing. That way you can project that out and ride them as things go on. That's what's most important here. The better you do on that investing fundamentally, then you can work on the most important part, which is handling your emotions. Not getting affected when you see GDP numbers come in like this, inflation numbers come in high. I want you to shift your thinking to the way I did. Now, the difference is you have the luxury of having the internet. When I was going through these changes, I didn't have YouTube. I was like, man, I had to read books and understand slowly. That's why in the last 4 or 5 years, my mentality has changed so much faster than it did in the first 4 or 5 years of me learning about investing. Why? Because I have the resources to focus and follow the people. We didn't have Warren Buffett on videos all the time now. We didn't have Ray Dalio. We didn't have all these great investors, Seth Klarman, Guy Spear, Monish Pabrai. We didn't have that back then. You have the advantage of being able to subscribe to this channel and learning from that. And then also being around a community of like-minded investors. We have the largest value investing community. But the most important part about that is the largest investor community of people who understand that controlling your emotions is the most important part about investing. You want to pick the right investments based on fundamentals, and you want to let them compound for a very long time based on handling your emotions. So that sounds appealing to you. The idea of being embracing of bad news so that you can use it as an opportunity to buy more. Look at today. What's down big today? Let's look it up. Right now, Meta, first and foremost. Look at this, down 11% right now. $55. $55. What's Google at today? Let's check out Google. A phenomenal company, down 3.6%, another $5. These are great companies. These are awesome, awesome companies these are Magnificent Seven companies that are down so big right now. These are growing businesses. Meta has 40% of the world using its products every single month, driving up their revenue. Their revenue is up 27%. Their expenses were only up 6%. That net difference is right to the bottom line. Even with Meta and their investment in the metaverse being terrible right now, as of right now, they're still growing. There's 7% daily active user growth. That's incredible. That is incredible. These are great companies that you need to learn what's the right price for. Because when you understand the right price and what's going to drive that value, when the market starts to go down and when the market starts to fall, let's pull up Meta right here. Remember, Meta fell. This was fear right here. People calling for Zuckerberg to be fired at $88 a share. You need to be able to sit there and say, nope, this is just temporary. I'm going to load up on the stock right now. If you'd loaded up all the way down here, it would have felt like you were wrong, and people would have told you were wrong. Who's laughing to the bank then? It's hard. It's simple, but it's not easy. But that's the key, being able to handle that emotion. And if you want to be able to handle that emotion, join the community, thousands of people. And guys, click the link below because we're going to have a wait list starting very soon. So if you don't sign up now, you have to go on the wait list to wait for your spot. So sign up now, $7 for 7 days to try it out. Get yourself in there. Use the software, talk in the community, and I assure you, it'll change the way in which you look at money. And that's what's most important. Because my goal for you is not only to make more money, but to be able to sleep better at night and handle your emotions better. That is what's so key. And I look at all of these companies that I love, and my goal is to buy bigger companies. So because of that, my returns are going to be lower, but I'm okay with that because I want to sleep at night. I want to be able to handle these reports that come out. Meta beating on earnings and revenue and going down. If you thought Meta was a buy at 500, what are you doing right now? You should be buying more shares, right? Using the logic here, down 11%. You're buying a company you love at a cheaper price. When you see GDP growth at 1.6 versus 2.4 and inflation higher, this should not be a sign of fear for you. If you want to have that mentality, that's why you subscribe to this channel. We're trying to sit here and teach people that so many things are going to happen in your lifetime. But the point is, if you believe in certain companies for a long period of time, if you believe in the U.S. economy for long periods of time, you realize at any given point, there's good news and bad news. 10 years ago, I used to be a fudster. I used to be this guy who's like, oh, things are going. Now I realize, no, I believe long term, but in the short run, I believe things were negative. In the long term, I said, yeah, the U.S. is going to be great. And I still believe that. Are there concerns? Of course there's concerns. I told you that before. When I see Joe Biden sitting there saying we're going to tax unrealized gains on stocks, I'm like, who do you think you're affecting? You're not affecting rich people. You're affecting the middle class who sits there and is trying to save money for retirement. Is it inconvenient for rich people? Sure, but they can afford it. Who you're killing, though? You're killing the middle class who should be investing and letting it compound tax-free for a long time. I look at that going, that's what worries me, that people think he's punishing a certain select group of people, and it's not. It's punishing the middle class. That's what it's doing. When I look at the debt levels on both sides of the aisle, these debt levels are crazy. And by the way, when it comes to unrealized gains, there's no way Nancy Pelosi is going to allow that to go through. That woman makes too much money off stocks to allow for a higher tax rate. That woman's the best investor to ever exist, right? So I look at this saying, hey, whatever side of the political aisle you're on, the bottom line is, if we have to get these costs into check, we have to sit there and understand that GDP is going to do what it's going to do. Your job is to find good companies at good prices, invest in them, and if the market shifts against them, as long as the fundamentals and the thesis are the same, you buy more of it. That's the power I want you to have as an investor. I don't want you to worry about these things, 3.4% versus 3.7. Interest rates are going down, interest rates are going up. Find good companies at good prices. And the great thing about Meta and Google is they don't have a lot of debt. These interest rates aren't going to affect them much at all. Their focus is how to grow these companies, how to grow their company revenue and profit at a much higher clip. Guys, click the link below, sign up, $7 for 7 days. I'll see you next time.